Welcome to the deep dive. Today, we're really digging into something we hear all the time, a real sticking point for a lot of you listeners.
Yeah, that question.
Exactly. Are mobile home parks overpriced? It's a conclusion so many people seem to jump to.
Yeah.
And you can kind of see why, right? You go online, browse some listings, see those asking prices, and bam.
The immediate reaction.
Yeah, wow, that's way too much. There's no way this works.
Right.
But today, we want to push past that surface gut reaction. We're going to try and look at this more, well, scientifically.
Scientifically, I like that.
Figure out what overpriced actually means in this specific market. And importantly, where the real opportunities might be hiding for people willing to, look a bit deeper.
That's really the core of it today. I mean, this perception that parks are overpriced,
Yeah.
it's everywhere.
Yeah.
And it's understandable looking at advertised prices.
Totally.
But for us, for smart investors, that gut feel or just what's on LoopNet, well, that's not quite enough, is it?
No.
We need a much more precise definition of overpriced if we're going to make genuinely informed decisions.
Okay, so let's define it then. What's the scientific definition?
Well, for an intelligent investor, overpriced really boils down to one critical financial relationship.
Okay.
It's the spread between your property's capitalization rate, the cap rate, and the interest rate you're paying on your loan. Is the cap rate higher than the interest rate?
Gotcha.
That positive spread, it's absolutely essential for a healthy, profitable investment. You want the property's income potential to outweigh your financing cost.
Makes sense.
So imagine a property generating, say, a 7% cap rate, but the interest rate you can get for your loan is 8%.
Oof.
Yeah, exactly.
Yep.
You're in what's called negative leverage right from the start. Your financing is actually costing you more than the property earns on its own.
Not a good place to be.
Definitely not.
Yeah.
So a market is truly overpriced when that happens consistently. When cap rates, on average, dip below the prevailing interest rates. That's the real danger sign. Because it means the cost of your capital, your debt, is actively working against your returns, not boosting them. And understanding that fundamental relationship, that's crucial for your potential profit. It helps you make a genuinely smart call.
Okay, that framework really clarifies things. And it actually reminds me of, times I've seen where the market really did fit that exact definition.
Oh, yeah.
Like back in the mid-2000s, right before the big crash.
The Great Recession, sure.
Yeah. That felt like a period where things really got fundamentally inverted, just like you described. People were buying properties, parks included, and their leverage, the debt they took on, it was actively hurting them. Instead of boosting gains, it was just making the losses bigger.
Amplifying returns into the red.
Exactly. Returns were literally driven negative by the financing. And that kind of thing, it's just not sustainable, right? It eventually catches up.
It always does.
So the big question then is, how does today's market stack up against that kind of, genuinely inverted situation?
Well, that history is super valuable context because the reality in the mobile home park market today, it's starkly different.
Okay, how so?
On basically every single deal that actually closes, that gets funded, you find that healthy, positive relationship. The cap rate is higher than the interest rate being paid on a loan.
Every single one.
Every single one that gets financed by a traditional lender, yes. And there's a really clear reason why.
Which is?
Modern lenders, they are incredibly rigid isn't quite the word, but maybe disciplined in their underwriting. They are, let's just say, they're not suicidal.
Huh, okay, fair enough.
They have really strict criteria, robust risk checks, and they simply will not finance a deal where the property's cap rate is lower than the interest rate they're charging. It won't pass underwriting.
So the lenders are kind of the backstop.
Exactly. It's not just some market quirk. It's like a fundamental gatekeeper. Lenders are, in effect, acting as a quality control for the whole industry, ensuring that basic financial viability. So really, this insight, it should reassure you, the listener. The market isn't inherently flawed or systemically overpriced right now, not in that dangerous, inverted way. If a deal closes, it's because the numbers at that point made sense to both the buyer and the lender.
Okay, so the lenders are like the ultimate check, almost a silent partner making sure the basic math works.
Pretty much, yeah.
But hang on, does that mean if a deal does close, it's automatically a good deal? Or does it just mean it meets the bank's minimum criteria? Is there still room to make a bad buy, even with strict lending?
That's a really excellent point to clarify, yes.
Yeah.
So a deal closing means it clears the lender's minimum financial hurdle, right? Debt service coverage, risk assessment, that's a big hurdle, absolutely.
Right.
But it doesn't automatically mean it's the best possible deal for you, or that the buyer negotiated the absolute best price for their particular strategy or goals. There's always nuance. Investors still absolutely need to do their own deep due diligence. But what it does mean is that the fundamental relationship, the income versus the debt, isn't upside down. It means the market, as a whole system, isn't overpriced in that historical, really dangerous sense.
Understood. Okay. That distinction is key perceived value versus that fundamental financial health. But, okay, if the numbers do make sense on closed deals today, why do so many people still feel like parks are overpriced? Where's that strong perception coming from?
Yeah, that perception, it often comes from, well, maybe a flawed way of looking for deals. What we could, affectionately call the lazy investor's approach.
Uh-oh. What's that?
It's relying only on the super easy to find stuff, like just scrolling through LoopNet or the mobile home park store online.
The big public listing sites.
Exactly. If that's your whole strategy, you're basically, well, you're not casting a wide enough net. You're kind of just fishing where everyone else is fishing, often for deals priced for maybe an uninformed buyer,
Fishing for idiots, as some might say.
Well, maybe fishing for someone willing to pay top dollar without digging deeper. Sellers are testing the market limits there. Or the deals listed might have, significant underlying problems that savvy investors spotted and passed on.
So the leftovers, potentially.
Sometimes. The point is, the really great deals, the ones with genuine value and solid upside, they often just don't make it onto those big, easily searchable platforms.
Right.
So if you, the listener, are only looking at what's served up easily online, I'd really encourage you reconsider your search method. Because you're almost certainly missing where the real value is hidden.
So wait, are you saying those online listings are never good deals? Or just that it's like way less likely for a really sharp investor? Could there still be a diamond in the rough online sometimes?
It's not never. I wouldn't say never. But the odds, they're significantly stacked against you finding a true gem there.
Okay.
Think about it logically. If a park is genuinely exceptional, it's priced right, has clear potential, it often gets snapped up fast, maybe before it even hits the public sites.
Through other channels?
Exactly. Through broker relationships, off-market contacts, things like that. What you see widely advertised has often been looked over, or maybe the seller just has really unrealistic price expectations.
Right.
For the really shrewd investor, the goal isn't just hoping for a lucky break scrolling online. It's about proactively uncovering opportunities that most people don't even see.
That makes total sense. Yeah, the best deals aren't just going to fall into your lap while you're watching TV.
Precisely.
The real barrier to entry, the thing that probably stops most people from finding these better opportunities, it's the effort. It's the work involved.
That's it.
If you're willing to put in that work, the deals are absolutely out there. And there seem to be, three main areas, three specific, harder methods for finding those true gems.
Exactly. 3 key strategies. And look, these aren't some kind of crazy industry secrets.
Right.
They're just methods that require, diligence.
Okay, lay them out for us.
All right. First, cold calling.
Yeah.
Now, this isn't just randomly dialing numbers. Not at all. No, it requires careful prep. You need to build your own specific list of park owners. Often means digging into public tax assessor records, filtering by property type, trying to find the private owners, not the big corporations.
So, targeted research first.
Absolutely. You're proactively seeking out the actual owners. Then comes the hard part for many.
Yeah.
You have to actually, get out of your comfort zone and contact them directly. Pick up the phone.
Yeah, I can see how that's daunting.
It really is. And the biggest hurdle often isn't just making the call, it's building some kind of rapport. It's not about a hard sell on the first call.
Right.
It's about being respectful, curious, maybe patient, asking about their park, how long they've owned it, if they've ever thought about what's next for the property.
Yeah.
You're starting a conversation, hopefully, not just making an offer. And that direct approach, it completely bypasses the public market.
Wow. Yeah, I can imagine the courage that takes. Just picking up the phone to a stranger about their property, that's a big step.
It is. But the potential rewards can be huge if you find someone receptive. Okay, second method, direct mail.
Like sending letters.
Exactly. This one is often seen as maybe less scary than cold calling for a lot of people. You've got a bit more distance, more control over the message.
Oh, okay.
But, and this is key, don't mistake less scary for less effort. It still requires putting in the time consistently sending out those letters.
Not just one batch.
No, absolutely not. This is about a sustained campaign, over months usually, sending multiple letters, maybe different versions, to that same carefully built list of owners.
What makes a good letter?
Often, it's about offering a potential solution, not just saying, I want to buy your park. Maybe hinting at helping them transition to retirement, simplifying their life, maybe taking over deferred maintenance hassles. You're trying to build a connection through consistent, thoughtful communication. You might just catch an owner when they're starting to think about selling, or maybe when no one else has reached out in such a personal way.
So it's about persistence, thoughtful messaging, not just blasting out junk mail.
Precisely. Okay, and the third method, pocket listings.
Pocket listings. Sounds exclusive.
They are. These are the deals that brokers hold on to privately. They never make it to LoopNet or the mobile home park store. They're unadvertised opportunities.
How do you get access to those?
Well, you can't just sit back and wait for a broker to call you. You have to be proactive. You need to talk to all the brokers who specialize in mobile home parks.
All of them. How many are there?
Oh, there are well over 100 dedicated brokers across the U.S. just focused on this asset class. It's a niche.
Wow. Okay.
But just talking to them isn't enough. This is crucial. You have to earn their respect. You need to show them you're a serious, capable buyer.
How do you do that?
Prove you have the funds lined up. Show you understand the market, the metrics. Demonstrate you can analyze a deal quickly and make clean decisions. Brokers, frankly, they don't waste time on tire kickers.
Right.
They'll only share these exclusive pocket listings with people they genuinely believe can and will actually close the deal. So it's not just who you know, it's about how you present yourself, showing you're committed and ready to execute.
Makes sense. Build that credibility.
Exactly. So those three methods, cold calling, direct mail, pocket listings, they all require significant effort, but they give you concrete, actionable ways to find much better opportunities. It really highlights how effort directly links to reward in this space.
Okay, that's super helpful. But now another big concern we often hear related to the overpriced idea is this feeling that, well, all the good deals are gone anyway.
Yes, the saturation argument.
Yeah, people look at all the institutional money, the big funds buying up real estate, and they assume the mobile home park market is just totally saturated now, that individual investors, like, our listeners, basically have no chance anymore. So what does this all really mean for the average person trying to get in?
That's a really, really common assumption. And understandable, you see the headlines, but honestly, it's fundamentally incorrect,
Right.
especially in mobile home parks.
Really? Why?
Let's just look at the raw numbers for a second. If we connect this to the bigger picture, it becomes clear. There are roughly about 44,000 mobile home parks across the United States.
Okay, that's a lot.
It is a substantial number. Now get this, less than 4,000 of those parks, that's less than 10%, are owned by the top 100 institutional players, the big guys.
Less than 10%. Wow.
Right. That statistic is incredibly revealing. It tells you the market is still highly fragmented. It is not saturated with large corporate owners who've already scooped everything up.
So who owns the other 90+%?
The vast majority are still owned by smaller private operators, often, classic mom and pop owners who might have held the park for decades.
Interesting.
And think about it. Life happens to these owners, right? Retirement comes up, maybe health issues arise, sometimes family succession plans fall through, or maybe they're just plain burned out after managing a property for 30 or 40 years.
Yeah, that makes sense.
Those are the catalysts. That's what makes them start thinking about selling. So this means the supply, the potential deals, it's still very much out there. In abundance, really. Opportunities are definitely still around for individual investors willing to do that legwork we talked about.
So you're not always competing against Blackstone.
Not at all. You're not fighting in a fully institutionalized market like, say, Class A office buildings. You're operating in a space still rich with individual ownership. And that, I think, is a really powerful counter-narrative. It shows you, the listener, that this market is far from exhausted. It's actually full of potential if you know where and how to look.
So it's not a static market where everyone just holds forever. There's this natural churn, people aging out or changing plans, constantly creating openings for those who are actively looking.
Exactly right. That's a great way to put it, natural churn.
That's a powerful shift in perspective, definitely. Okay, so we've kind of tackled the overpriced myth. We've clarified what a healthy market actually looks like financially, and we've addressed that all the good deals are gone. Fear. What seems to tie all this together, then, is really hammering home the understanding that this is absolutely not a get-rich-quick kind of industry.
Oh, definitely not.
It's appealing, sure, there's opportunity, but it seems built on something much more, foundational, like consistent effort, having a real strategy, and, frankly, patience. time.
It's a marathon, not a sprint. Absolutely.
Yeah, like, okay, here's an analogy. It's like going to the gym, right? You're not going to gain muscle or lose weight or see any real change by just showing up once a year or even like once a month randomly.
Sure.
Those sporadic, kind of half-hearted attempts, and they just give you sporadic, half-hearted results or no results.
That analogy holds up perfectly. It really does. Consistency, having intention behind what you're doing, and that sustained effort, those are the absolute cornerstones here.
Right.
You can't just hope for good deals to find you. You have to actively, methodically work towards uncovering them day in, day out, week after week.
Like planting a seed.
Exactly like planting a tree, yeah. You don't get the shade and the fruit the next day. You plant the seed, you water it consistently, you protect it, and then over time, it grows into something substantial. The gym rewards you for showing up consistently, right? For pushing yourself, following a plan over the long haul. And it's precisely that same kind of consistent, focused effort that rewards you in mobile home park investing. It's about patiently applying those harder methods we talked about, the calling, the mail, the networking, diligently analyzing the deals you do find, and just understanding that real wealth building, it takes that long-term, committed approach.
Yeah.
And honestly, that principle, it applies pretty much anywhere you're trying to build wealth. It encourages you, the listener, to adopt that diligent strategic mindset instead of just chasing, the next quick buck.
So wrapping this up, to give you, our listeners, a definitive answer to that big initial question.
Yeah.
No, mobile home parks are absolutely not overpriced, at least not by any sound financial definition of the term. And no, all the great deals are certainly not gone.
Not by a long shot.
The opportunities are definitely still out there waiting for you to uncover them.
That is the key takeaway.
Yeah.
The deals are there. They are right for the taking, but, and this is the crucial caveat, the absolute truth of it.
Here it comes.
You have to put in the effort to get them. They won't just land in your inbox. You have to actively seek them out using those smart, consistent strategies we discussed.
Right.
Which really leaves one final important question for you, the listener, to think about. What kind of effort are you truly willing to invest? What level of work will you put in to unlock those opportunities that, frankly, aren't just advertised to the masses on Zillow? What hidden markets, what unadvertised paths might you be overlooking, maybe in your own career or investments, simply because the barrier to entry requires more than just a casual glance or a quick Google search?